Krishna Memani, good morning. Thank you for joining us. First things first, what has changed for emerging markets in last few weeks and why the case for emerging markets is looking so strong?
Well, so what has changed is the Fed's positioning with respect to the U.S. economy. If you remember, in 2017 and 2018, the Fed was tightening policy. And when the Fed typically tightens policy, flows reverse out of emerging markets and back into the U.S. Coming into 2019, that expectations changed. And as a result, people have been buyers of emerging markets. And India clearly is benefiting from those general flows going out of the developed markets into emerging markets.
So, Krishna, how serious is the global slowdown? You know, because typically if Fed is making a view that interest rates should go down, that also means that US economy will slow down. That also means that they cannot increase interest rates because the underlying growth of the US economic expansion will remain poor. So I wonder, should one get excited about the flow picture? Because flows are coming back because Fed is decreasing rates. But Fed will decrease rates because the economy is also slowing down.
Well, so, you know, what we are talking about is slowing growth from a relatively high levels and lack of inflation. So our expectation is that by the second half of this year, after going through a soft patch, 2019 growth would probably end up close to 2%. And that's a relatively good environment for even for a developed market like the U.S. And with no inflation and Fed not tightening policy, effectively this is an environment where equities should do reasonably well. Given high levels of equity valuations in the developed markets, people have started investing in a reasonable way into emerging markets where valuations are significantly better, and the risks associated with emerging markets getting into a recession because of the Fed's tightening posture, those risks have gone down.
Krishna, morning. So what would you say? I mean, how long do cycles like these last particularly, especially for EMs? What would you say is the outlook now?
Well, I think our expectation is that the current growth cycle in the U.S. and by correlation, other developed markets probably lasts a while longer. 5 more years is the way we are characterizing it. The idea is with lack of inflation and decent amount of monetary policy support, the current cycle can extend itself. In that environment, emerging markets should do reasonably well because looking for returns, people would be focused on where the growth is. And the current global context, the highest level of growth is really in emerging markets. So yes, to the extent that Fed maintains its policy, and we expect them to, the outlook for emerging markets for the next few years is quite good.
Right. And the outlook for EMs and the outlook on those economies moving, do you think is moving in tandem?
That's actually a very good question. So I think the outlook for emerging market economies is a little bit more mixed. So you have places like India, where the underlying growth trend is relatively stable, you know, give or take a few percentage points depending on policy. But then you have places like Brazil and China, where the outlook is far more suspect. So things are slowing down in China. They are trying to re-stimulate things by easing policy, both monetary and fiscal, and therefore for 2019 the growth outlook is quite good. Whether that sustains itself in 2020 or 2021 is a very open question. So yes, markets are good because flows are flowing out of developed markets into emerging markets. However, whether the underlying economies grow at the fast pace that they did, let's say, beginning of this century or even after the financial crisis, I think that is a really open question that we'll be debating for quite some time.
Krishna, have you taken a relook at your stance on India recently? How are you approaching the Indian market in the current context?
Well, we really haven't changed our India positioning in a meaningful way. We have been believers in some very specific Indian growth stories for quite some time, and we are basically sticking with that. Our flows are really not that driven by near-term Fed policy and things like that. We are more driven by good companies that are executing really well, where we can stay with those companies for 10, 15, 20 years. And that's how our operating principle has been with respect to our Indian investments. That's typically not the case for most other emerging market funds.
True, but what about valuations? That continues to be the big question. Are you finding them attractive at these levels?
That's an interesting way to put it. There's a great deal of truth to that. Indian equity valuations are not cheap relative to other emerging markets. Having said that, not having a decent allocation into Indian equities is something that no emerging market manager really wants to do. So they go into these Fed-driven flows as opposed to company-driven flows, which is what we are part of. The Fed-driven flows into emerging markets end up in India as placeholders far more than that, and far more than anything else. And you see that in kind of the sort of names that they are buying, the companies that they are buying. It's basically companies where, well-known companies where the relative underperformance risk relative to the Indian benchmarks is quite modest. That's what what we call tourist flows focus on.
So what kind of stock and companies are you focusing on in your India portfolio? I mean, what I know about your portfolio is that you are this long haul guy who would take a 10-12 year time frame.
Well, so I would clarify that a little bit. Our focus in India is really about companies that we believe will do very well because they have good management teams, and where the businesses that they are in are long-term businesses. So I would say IT sector, for example, remains a focus for us, and we don't really worry too much about near-term valuations in those types of things. Banks for us are quite attractive because bank valuations are pretty good, and I think financialization of Indian markets will probably continue for quite some time. So banks as intermediaries in that context should do reasonably well. And then we focus on individual banks that we think are executing pretty well. Companies like HDFC. Even on occasion, when you have a company like ICICI, for example, where things have kind of underperformed for some temporary reason. However, the underlying core strength of the company is quite good, and then we can buy them at a cheap valuation. We'll surely look at it.
So let's talk about financials, because you mentioned financials. How do you think the NPL situation in the financial sector has moved? And one side you've got this whole opportunity which is coming back into corporate banks. Do you think the growth in a sense could be a challenge because credit offtake numbers have not normalized?
Well, I don't think it's train wreck. If the Reserve Bank adopts reasonable policies, I think it's a very solvable problem. Having said that, I think this is something that they had to do. That is, the NPL position of the Indian financial sector is very problematic, and I think finding ways of solving that problem while not throwing out the baby with the bathwater, I think is the right way to approach things. That is, the central government has to make sure that credit creation remains relatively stable, but at the same time coming up with policies to solve the long-term problem of NPLs and these banks being saddled with all these humongous non-performing positions, I think is the right thing to do. In the short run, there's always going to be a price to pay, but I think from a long-term perspective, it is something that is going to pay rich dividends.
Krishna, we've got a very big overhang of a very critical event, that's the elections. But how important or critical a factor do you think would elections be for the markets?
Well, so first of all, I don't think the elections are going to be market unfriendly. That is, Modi may not get the majority that he's looking for, but the likelihood that he doesn't get elected, at least in our judgment, is relatively modest. So that's what the markets are pricing in. So we don't anticipate a meaningful underperformance of the market because of the election results. Having said that, I think the long-term growth story in India is very much intact. So even if this election ends up being not too market-friendly, our expectation is that to fulfill the aspirations of Indians down the road at some point, and some point in not too distant a future, policies, irrespective of who gets elected, policies would have to be good economic policies that support long-term growth. And we believe India is likely to remain the fastest growing long-term economy in the world. And therefore, if there are market opportunities like that, we would certainly take advantage of that.
Now, Krishna, some would argue that if the current administration comes back into power, nothing much could actually change, because 5 years ago, when the current government came into power, the general view was that earnings will pick up, banking sector will revive, all the basic leakages in the economy will get picked up, and India will be back on a 6% or 7% plus GDP growth track. But nothing of that has happened. Earnings have still deceived us. So some would argue that even the market secretly wants the current administration to make a comeback. Even if the current administration makes a comeback, which is that if Modi Sarkar comes back, what really changes?
Well, so that's a really good question, and I think I'm hoping, as a fellow Indian and part of the the global Indian community, I'm hoping that the Modi government has at least learned some lessons out of the policies that it implemented. Demonetization clearly was a disaster, an uncalled for disaster. It didn't accomplish anything and caused a great deal of commotion. GST, on the other hand, it has caused near-term problems. However, from a longer-term perspective, it is probably the most important piece of legislation that got passed, because it provides for a resource mobilization that didn't exist before. Similarly, I think solving the NPL problem is short-term pain but long-term gain. So I would say that some of the policies that they have implemented have been really good policies, and some of other policies that they have implemented that haven't been as good, hopefully they have learned some lessons from that. And in the new regime, they will take advantage of that, and the fact that they have had a little bit of trouble of late gets them more focused on economic growth, which is what India needs more than anything else.
So overall, what you're saying then, Krishna, is that due to a change in the Fed's stand, it will mean further good news for global equities.
Well, so Mr. Marks only had to go to December to see that that is absolutely not correct. That is, from September to end of December, equity markets corrected almost, take the market maybe anywhere from 10 to 20 percentage points. So.
Right, and I'm going to come back to you on that. But Krishna, are you confident that this cycle can last a further 5 years? And when it comes to the drivers that we're looking at, which of them do you think are the strongest?
Yes, indeed. We, again, as I mentioned before, our outlook is this cycle lasts, at least the economic cycle lasts for another 5 years. And whether it's going to be precisely 5 years, I don't know. What I do know is that for any relevant investment horizon, the outlook is still quite positive. And the drivers of that are relatively straightforward. Supportive monetary policy, lack of inflation, and no significant misallocation of resources in any part of the U.S. and developed market economy. I think that's really what will probably extend the cycle more than anything else. Look, markets or economies don't die natural deaths. They are driven to that either by some sort of excesses or by bad policy. And I think the Fed pivoting and the fact that the banking system is not over-levered, the fact that credit spreads are relatively stable, fact that credit growth hasn't been extraordinarily large, I think all of those things will probably support the economy for quite some time.
Okay, let's talk about some specific ideas then, and let's talk about the prospects of the IT sector. What kind of stocks would you say you think can ride the cycle? Or does IT even make sense right now at a time when the rupee is inversing?
Well, so I think the good Indian IT companies will survive, and they will have to reinvent themselves. So the point with respect to IT investment is not as a sectoral investment as much as it is finding good companies where we believe they can revive their growth plans because they have the ability to innovate and reinvent themselves. So that is not going to be the case if you are going to be a low-end service provider. You will have to move upstream and continue to grow your product portfolio, especially in areas where there's growth, which is cloud, artificial intelligence, data science, those types of things. If you want to remain a BPO or a glorified BPO, then the outlook doesn't look that good. So it's really more company specific rather than sector specific.
Consumer companies, Krishna, in India are expensive, but the challenge is that that's where the growth is. Now, since you believe in buying companies for 5 to 10 years, do you think one should not shy away from buying these stocks which are trading at P multiples of 40 times, 50 times? You may not make money this year, next year, but eventually in a 10-year time frame, 12-year time frame, consumer is where you should be, and consumer is where even though P multiples are elevated, they will get even out as time moves forward.
Well, so this is the biggest challenge with consumer companies. The best story in India is consumption, for sure. However, if you can't find a company that is reasonably valued, then you are basically paying somebody else for coming in. And that's, as an investor, that doesn't really make much sense. So our outlook for consumer sectors is really not that great. It's not a sector that there are companies that we look at, but as a sector, that's not where we are focused on. Where we are focused on, where the outlook is good and reasonable valuations persist, and where we can come in at a good enough entry point. If some of them correct, that we will certainly look at them. But today they don't offer much value.
Krishna, on a different note, talk to us a little about the promoters that you really like in India, perhaps in the companies that you've held for a long time, that you've had an experience dealing with. Where would your preferences lie?
Well, so I can't talk about specific companies, but I would say that there are lots of really good promoters in India. And one example that I would give is take HDFC. This is a company that we have been with for a very long period of time. They have delivered. They have been fair to their shareholders. It's a great company, and we believe there are plenty of opportunities like that in India.
Appreciate your time, and so we are really grateful and thankful that you could find time to accommodate this interview request. Now,